Hello everyone, I'm Nova Lui, RHB Bank's Head of Investors Advisory. As US market has rebounded from its recent bottom in June 2022, but Chinese equity market continued its downward trajectory since then. Let's hear from Tan Jitun, CIO of Asia Pacific Equity, RHB Asset Management Singapore. Hi Jitun, US has kickstarted the quarter 2 earning reporting season. 75% of the company earning reported so far has beat market expectation. Do you think this can continue to be a main catalyst to drive US equity market higher?
From the early part of this year, concerns over aggressive US interest rate hikes to combat inflation have led to widespread market declines. Indeed, we have seen that around 75% of the US companies that have reported so far have beaten market expectations, led by energy and material sectors. This has enabled the S&P 500 to recently bounce back somewhat from recent lows. The US GDP has shrunk for 2 consecutive quarters, which technically meets a long-held definition of a recession. However, President Biden and the US Federal Reserve Governor Jerome Powell have taken great pains to not label this a recession as yet. Regardless of the official definition of a recession, we remain hopeful that the US Federal Reserve will be able to engineer a soft landing of the economy, buffered by the current strong labor market and rising wages. In addition, by middle of June, the US market had already entered into a bear market, declining by over 20% from its recent peak in January. This decline has somewhat priced in the current weakness in the US economy. The market was also cheered by the latest comments from Fed Chair Powell, who acknowledged the slowing economy and will assess rate hikes on a meeting-by-meeting basis, with decisions being data-dependent going forward.
Okay, great. Let's move on to the next major global economy. A lot of our investors has exposure in China equity fund. We have heard a lot about tail end of Chinese government crackdown on technology stocks. Recently, TT Global was fined 1.2 billion US dollar after cybersecurity probe. Has this changed your view on Chinese technology company as a whole? Do investors react negatively on this news?
The market has been worried about the regulatory scrutiny on the Chinese internet sector ever since Ant IPO was put last minute in November 2020. Subsequently, the slew of new regulations and leveling of fines for past mistakes caused the China internet sector to suffer a severe derating in 2021. However, in light of China's slowing economic growth and the government's need to look for ways to improve the economy, we believe that the crackdown on domestic technology and internet sector is easing. In fact, the recent statements by Vice Premier Liu He and other senior Chinese leaders in recent months signal an important turn in the policy stance of the Chinese government. The statements mention that relevant government departments should complete the rectification work on large internet platform companies as soon as possible, promote the steady and healthy development of the internet platform economy, and improve its international competitiveness. The statements illustrated that the broad policy stance would remain highly supportive and the recovery of the economy is receiving the highest attention by the senior leadership of China. Recent news of the conclusion of TT's probe and subsequent fine, and rumors of Ant Group's IPO returning are perhaps concrete signs that the sweeping regulatory changes is entering into a stable phase. As regulations stabilize, so too would the market, and the overall development of the internet sector would benefit from more predictable and transparent regulations in the future.
Property investment has been long perceived by Asian investors, especially as a long-term investment tool. However, we have begun to hear less positive news, including property sector in China. Property projects by China Evergrande Group and CNET Group has sparked nationwide protests in China, where participants staged a boycott on mortgage loan linked to such properties. Is there any spillover effect from this event and cause major sell down in other related sector? Jitun, what is your view?
News surfaced recently in China that as acts of protest against property developers that have stopped construction on unfinished apartments, apartment buyers are withholding payments on their mortgages. Such incidents, helped by social media, gathered steam and spread to more than 300 uncompleted property developments within the space of 2 weeks. However, it is important to note that these affected property developments accounted for less than 2% of total outstanding balance of mortgage loans in China. In addition, multiple large Chinese banks have disclosed their current overdue exposures to such mortgage holders as less than 0.01% of their first quarter 2022 loans. Generally speaking, mortgage loans are of long duration with high quality collateral and high recovery rates, unless property values decline by more than 30%, which would lead to negative equity mortgage loans. However, such a sharp decline in property values is not a base case in our view. The Chinese central government has also announced that they are planning to create a real estate fund to provide financial support to distressed property developers selected by the government. Financial Times reported that the size of this fund could be as big as 1 trillion renminbi. Given the importance of the property sector in China, we believe that stability in the property sector will be a priority for the central government.
Jitun, thank you very much for your insight on US and China market. Let's move on to our next speaker. Michael Cheng, CIO of Global Fixed Income in RHB Asset Management Malaysia. Hi Michael, let's start with the US Fed rate hike before moving closer to home. US headline inflation has been gradually rising on a month-on-month basis. In your opinion, is the US Fed rate hike in July within the market expectation? Is it possible for US Fed to taper or reverse its currently aggressive rate hiking anytime soon?
On July 27, US Fed hiked its US federal funds rate target by 75 basis points to 2.25% to 2.5%. The 75 basis points was within market expectations, and post the increase, there was a rally in the US Treasury market, which also led similar rallies in other bond markets, especially those in the advanced economies. Recap: US had its first hike by 25 basis points in March, followed by 50 basis points in May, 75 basis points in June, and 75 basis points in July to 2.25% to 2.5%. Going forward, the market is looking at odds of 50 basis points each in September and November 2022, respectively. While Fed funds rate is still likely to go higher as US grapples with inflation, the quantum of hike at each forward meeting is likely smaller to avoid over-tightening of financial conditions, suppressing US economic growth.
In Southeast Asia, we noticed that Singapore and Philippine central banks have started to enact aggressive monetary tightening. Do you think Malaysia will follow the trend to raise further 25 basis points in end of each meetings in September and November?
We believe Bank Negara Malaysia will still hike in September and November 2022 of 25 basis points at each of these meetings to end 2022 at 2.75% on the back of a rebound of the Malaysian economy in 2022 versus 2021. We expect the resilience of the Malaysian economy to support the normalization of interest rates in Malaysia, while ensuring the interest rate differential between US and Malaysia does not widen excessively from the US aggressive rate moves this year. Malaysia also adopts less aggressive rate moves in managing inflation, which is commercially more conducive in nature compared to Singapore or the Philippines. That said, we expect ASEAN Central Bank rate hikes to lag the US Fed, as ASEAN intends to just hike to a level just below its neutral rate, as the purpose is merely to reduce the degree of monetary accommodation to support the economic recovery. This flexibility is made possible because inflation within ASEAN is lower compared to the other parts of the world.
Monetary policy and rate hikes are highly correlated to the fixed income investment. Despite recent rate hike and market expectation on further rate hike in future, we observe a price uptrend in Malaysia MGS market. Do you foresee that momentum to continue likely for both government and corporate bond in Malaysia?
We are constructive of the outlook for both Malaysia government securities and corporate bond markets because we believe there is value in them, as Malaysia is already midway to its rate tightening cycle and likely to pause in first half of 2023. Given this base case and outlook, prevailing yields would have value as it adjusts to the increases in the overnight policy rate, and spreads against OPR will likely tighten for both government and corporate bond securities. We are still wide currently. Therefore, we envisage bond prices for Malaysia to gradually move up going forward after a bearish start in first half of 2022.
Very well. This podcast will not complete without insight on our Malaysia equity market. We have our final speaker here, Encik Muhammad Fauzi, CIO Equity of RHB Asset Management in Malaysia. Encik Fauzi, Malaysia's inflation rate is relatively low compared to other countries globally. However, this is partially due to government subsidies. This has put a lot of pressure on government, and there is potential for subsidies to be gradually reduced. What will this happen if we will reduce consumer disposable income? Is there any particular sector that investors should watch out for?
Before I touch on the impact of high inflation on consumer, let me briefly explain what has happened to the earnings growth outlook. The high inflation and high interest rate has dampened the market sentiment, not only globally but also Malaysia. The earnings growth, which is key to the performance of the index, has been revised downwards recently. However, the downgrade in the earnings was lagging the performance of the index. The largest impact from a high inflationary environment is on the consumer's wallet. As such, in the shorter term, sectors which likely have the largest negative impact from accelerating inflation are big ticket spends such as property and automotive, which then translate to banks, plus consumer discretionary sectors such as retailing, brewers and gaming. Plantation is seen as a potential beneficiary as palm oil is the cheapest vegetable oil in the complex. For other sectors, the impact is less immediate as some are able to pass on rising costs, for example, some technology, energy and construction companies, while others have locked in existing contracts, for example, telecommunication companies. In the longer term, however, there is risk of margin compression and weak demand if the high inflationary environment persists.
Malaysia has seen rebound in COVID-19 cases due to widely available test kits, including unreported cases. Actual cases might be much higher than we know. In your opinion, will the government step up and tighten SOP? How much is this expected to impact our overall economic growth?
Malaysia's economy was hit the hardest during the implementations of the first MCO, where it ventured into negative territory in second quarter 2020, and the economy dipped to minus 17.1%. The economy again dropped to minus 4.5% when Malaysia again went into full MCO from May 2021. Malaysia has reopened its borders since 1st April 2022 and transitioning to endemicity, and all economic sectors in Malaysia have back to normal. Most of the new detected COVID-19 cases are in categories 1 and 2, showing no or mild symptoms. As of 2nd August 2022, 84.1% of total populations have received 2 doses, whilst 49.6% of total populations have received first booster jab and 1.1% received second booster jab. Malaysia economy is on an upward track to recovery from the pandemic following a successful vaccination efforts and full lifting of movement restrictions. Malaysia economy is expected to be on track to recover in 2022. Hence, we don't expect the government to tighten SOP in the future as it would have bad implications on the economy. In fact, other countries have gradually opened up their economies, which also include China, which implements strict zero COVID policy restrictions.
Alright, this is my last question, potentially the hardest one, Encik Fauzi. Malaysia general election. This seems to be growing expectation of general election this year, while reports suggest that Election Commission EC was increasingly busy. Are we anticipating an election this year? Most importantly, what are the expected reaction from foreign investors on the possibility of election?
While investors typically prefer not to speculate on the timing of political events, in a potential election year, we have noticed that foreign investors' interest will be more muted given the possible event risk. Malaysia, relatively small weighting in regional and global benchmark indices mean that foreign investors have the option to focus on other markets in the meantime and wait until the elections are over before coming back into the market. That being said, the Malaysian market valuations are comparatively attractive compared to peers, and we have noticed that foreign investors turned net buyer in July after having sold in June.
Thank you to all speakers to share your thoughts to our investors. Dear investors, investment is dynamic. We hope our podcasts are able to provide insight on recent issues that is affecting both equity and fixed income market in order to assist you in making informed investment decisions. Please visit our RHB Merge website to view more of our other podcasts, money chat, and financial related articles. Any question, please feel free to engage our relationship manager. Take care and stay safe.